Welcome back, everyone. Last time we talked about choices under risk and defined expected utility, our tool for evaluating choices under risk. Today we're going to talk about how we can reduce the risk to which we're exposed and talk about the demand for risky assets. And what we're doing is applying our concept of choice under risk to some various economic settings. So we'll start with a section on reducing risk, in which we'll describe three common ways that both businesses and consumers can reduce risks: diversification, insurance, and obtaining more information. And by obtaining more information, we mean both in terms of choice, but also in terms of payoff. Let's start with diversification. Diversification is a way to reduce risk by allocating resources to a variety of activities. Henry Markowitz won the Nobel Prize in 1990 for his portfolio theory. This was a theory of diversification. So let's suppose you're a salesperson and you sell appliances. Well, there are two common appliances you can sell. You can sell air conditioners and you can sell heaters. Let's take a minute to think about what these appliances imply about the world around us, because usually when people are buying air conditioners, they're not also buying heaters. When air conditioner sales are up, heater sales are down, because you buy an air conditioner when it's hot out and you buy a heater when it's cold out. In other words, the sales numbers for these two appliances are negatively correlated. They have a tendency to move in opposite directions. Let's see what this means in terms of how we can reduce our risk as a salesperson. And to answer that question, let's assume that there are two states of the world. There's the state of the world that's hot, and there's the state of the world that's cold. If the world is hot and you sell only air conditioners, your income will be $30,000. If the world is cold and you sell only air conditioners, your income will be $12,000. Keep in mind that people don't buy air conditioners when it's cold out. Similarly, if the world is cold and you sell heaters, your income will be $30,000. And if the world is hot and you sell heaters, your income will be $12,000. Put differently, if you sell only one, your income will be either $12,000 or $30,000. Either you sell only air conditioners and it's either hot or cold, or you sell only heaters and it's either hot or cold. We can only be in one state of the world or the other, the hot world or the cold world. But there's another option, and that option is to diversify, which is you as a salesperson can divide your time evenly between the two products, in which case you can expect to sell more air conditioners in the hot weather and more heaters in the cold weather. If you diversify your time, your expected income is $21,000, assuming it's equal probability that it's hot and cold. Now, $21,000 is less than your maximum earnings of $30,000, but it helps mitigate this downside risk where you're trying to sell heaters in hot weather. In practice, we see this sort of diversification when people invest in the stock market. Rather than picking individual stocks, people tend to invest in things like mutual funds, which pool a bunch of money from a bunch of different investors to buy a whole bunch of different financial assets. Now, some stocks hit it big and some stocks go broke, but when you invest in a mutual fund rather than an individual stock, you get the benefit of being invested across the market. And stocks on the whole are positively correlated, which is when the market is doing well, stocks in general tend to do well. So a mutual fund takes advantage of positively correlated variables, as opposed to the salesperson on the last slide took advantage of negatively correlated variables. What are some other ways we can reduce risk? Well, we can buy insurance. And insurance is a state contingent claim that just pays out in the bad state of the world. So previously, we saw a salesperson deciding whether or not to sell heaters or air conditioners in a world that could be either hot or cold. So if you're a salesperson selling heaters, the bad state of the world is a hot world. No one wants to buy heaters in a hot world. So rather than diversifying by selling both heaters and air conditioners, maybe the salesperson could take out an insurance claim where they get paid out if the world ends up being hot and no one is buying heaters. Let's explore the decision to buy insurance, the decision to insure, a little bit more in this table. And let's explore this decision in the context of a burglary. So in a world where you don't have insurance and you don't get burgled, you have $50,000 worth of stuff in your house. What happens when a robber comes to your house? Well, you still have stuff in your house. It's still worth some amount of money. But they might get some of your stuff. If a robber comes to your house, let's say this happens 10% of the time. If a robber comes to your house, they're going to walk away with $10,000 worth of your stuff. In other words, in the state of the world where there's no burglary, you have $50,000. In the state of the world with a burglary, you have $40,000. Burglaries happen 10% of the time, which means in expectation, you have $49,000. But there's a large standard deviation in your wealth between the good state of the world, where there's no burglary, and the bad state of the world, where you get robbed. What insurance does is in both states of the world, burglary and no burglary, you pay some amount, in this case, $1,000. So if there's no burglary, you're paying $1,000 to the insurance company, and you're worth $49,000. If there is a burglary, you're paying $1,000 to the insurance company, but they're refunding that $10,000 that the burglar steals from you. So in both the case of the burglary and no burglary, you have an expected wealth of $49,000. And it's not even an expectation, it's a realized wealth. Because either you don't get robbed, but you're paying the insurance company, or you do get robbed, you're paying the insurance company, but you get reimbursed for your losses. So in the case of insurance, you have the same expected wealth as in the uninsured case, but there's no standard deviation. You have that result with certainty. Remembering what we learned in the last lecture, for risk-averse individuals with equal expected values and smaller risk, the risk-averse individual will take the smaller risk. They are willing to sacrifice the positive upside of having $50,000 for the decreased variance in outcomes. In other words, they're experiencing higher utility because they purchased insurance. They paid that risk premium. What about on the other side of things? Why might an insurance company be willing to write some people a $10,000 check some of the time? The reason is because insurance companies insure a lot of people. They're subject to the law of large numbers, where some people are getting a $10,000 check, but the insurance company is getting a $1,000 check from you, and you, and you, and me, and Dean Garrett, and President Wu, and not all of us are getting robbed on the same day. In other words, they're diversifying, like we learned in that first slide. They're selling a large number of policies and facing relatively little risk. They're able to do this because burglaries are a random event based on the law of large numbers. So although it might be impossible to predict who gets robbed on any given day, in the grand scheme of things, we can predict that people get robbed about 10% of the time. Now, the insurance policy we saw on the last slide is what we would call actuarially fair, in that people get robbed about 10% of the time, and when you get robbed, the insurance company pays you $10,000. So if the insurance company is paying out $10,000 about 10% of the time, they'll charge you $1,000 for your insurance policy. That's actuarially fair. The insurance premium is equal to the expected payout. There's one other way in which we can commonly reduce risk. There's one other common way in which we can reduce risk, I should say, which is obtaining more information. And we can learn more either about the outcomes or about the payoffs of these outcomes. This mode of reducing risk should be very important to you all as people who are about to enter the job market, because when you get offered your first job and your next job, what your offer letter is going to say is employment is contingent on a background check. So how does your future company reduce the risk of you? How do they seek out more information? They pay to conduct a background check on you. They pay money to get more information, and that information will tell them that you don't have a history of robbing companies. Thus, they're more comfortable offering you this contract. What does information do? It moves us from an uncertain situation towards a certain one. So let's consider the situation on the slide where there's another salesperson and they're selling suits. On any given day, a salesperson can sell 50 suits or they can sell 100 suits. They don't know in advance how many suits there will be demand for. So they can either buy 50 suits or they can buy 100 suits. If you buy 50 and there's demand for 100, you're leaving money on the table. You're not getting an extra $12,000 in profit. But if you buy 100 and there's only demand for 50, you're losing a lot of money because you have unsold merchandise. If you had complete information, you would buy the right number of suits in each scenario, 50 when there was demand for 50, and 100 when there was demand for 100, which would give us an expected profit in an equally likely scenario of $8,500. From here, we can price out how much complete information is worth, because if we were in an uncertain situation, that's buying 100 units, because if we buy 50, we're always selling 50. But if we are in an uncertain situation where we buy 100, our expected profit is $6,750. So by taking the expected value under complete information and subtracting the expected value of an uncertain situation, we can price out how valuable complete information is. Next, we want to look at how people decide how much risk to bear when making investments and when planning for the future. So this next set of slides should help you in your 170 and 180 classes. To look at the demand for risky assets, we need to first clear up a bunch of vocabulary. An asset is something that provides a flow of money. When that asset increases in value, we have a gain, a capital gain. When it decreases in value, we have a loss. Risky assets provide uncertain flows of money. So a risky asset might be a stock, in that it might increase or decrease in value at some unknown rate. There are also riskless or risk-free assets which provide certain flows of money, like annuities. The monetary flows that one receives from these asset ownerships can either be explicit, like a payment, or implicit in the form of increased or decreased value. what we see in practice is that assets that offer higher average rates of return also expose us to greater risk, and lower rates of return expose us to less risk. In other words, risky assets must have higher expected returns, otherwise risk-averse investors would only buy the risk-free assets. Let's assume treasury bills are risk-free and examine this trade-off with treasury bills and stock market assets. So we have some investor who can place some proportion of their income, B, into the stock market, the rest of their income, 1 minus B, let's assume income equals 1. So if B goes into the stock market, 1 minus B can go into risk-free treasury bills. Thus, the expected return on her portfolio is the weighted average of the expected return from the market, weighted by B, the proportion of income in the market, plus the expected return on the treasury bill, weighted by 1 minus B, the proportion in riskless assets. We can calculate how much risk is in your portfolio by just weighting the risk, the standard deviation of stock market investments, by the proportion that you invest in the stock market. So to solve the investor's choice problem, we just solve the same utility maximizing problem we've been dealing with for a couple chapters now. We solve the same consumer maximization bundle, where we need to know consumer preferences and we need to know income and relative prices. The relative prices in this case is the slope of the budget line, the expected returns on the market minus the riskless asset, over the constant risk in the market. This is the price of risk. So since the risk in your portfolio is just the fraction you have invested in the market multiplied by the risk in the market, your optimal amount to invest in the market is just the ratio of risk to your portfolio over the ratio of risk to the market. From here, we can get your budget line. And again, the budget line in this case is just the price of risk. So remember from last lecture, we can draw indifference curves over your risk preferences, and the investor who maximizes her portfolio just puts herself on the highest indifference curve, highest risk indifference curve that she can afford based on the budget. Spend all her money such that she's on her highest indifference curve. So how much risk is someone willing to bear? That just depends on their preferences. And two different investors might be willing to bear two different amounts of risky assets. Remember from last lecture that more risk-averse people have steeper risk indifference curves, and more risk-loving, more risk-seeking people have flatter indifference curves. The degree of extra risk that each investor is willing to bear in order to earn their maximum expected return depends on how risk-averse they are. And less risk-averse investors, so more risk-seeking investors, tend to include a higher fraction of risky assets relative to risk-averse people.